Hello, and welcome to the season finale of Risk Management video series. So this last project is pretty easy, or, well, I don't know about easy. Nothing in this class is easy, but at least it's fairly straightforward. We're not going to use too much Excel in it. The first thing that we want to do is create a hedge using puts on the E-mini futures contract rather than using the contracts themselves. So just to give you an idea of what we're talking about, if I come here into the CME group, and we're interested in, again, the ES, which is the E-mini series, E-minis, and then we just click on our options. So the S&P closed today at 1885.08. So what you would do here is basically take out a put contract that's at the money, in this case 1885. You'd be long that one. It'd take you cost you $22.50, and then you'd short one of the contracts that have a slightly lower price to create a bear spread with puts. I've listed this website just to give you a little more background on how to set the put spread with the E-minis. And all you do is set it up, tell me what strike prices are, the money you put in, net investment, and why you picked the stock prices or the strike prices that you did, and you're good to go. Okay, just give me a little bit of feel that you've taken a look at what needs to be done for it. If the class was longer, I probably would have introduced this a little bit shorter and had you track performance for a while to see how well your hedge worked. And of course, in this market, it may not have worked very well. And just to, as I mentioned in class, the option contracts on the S&P are where the VIX comes from, which is the volatility index for the S&P 500. The 12.42 here is the implied volatility from the actual options. We can look at a history. I'm going to click on a 5-year history here. And we can see there's been a number of very high peaks in the past 5 years. And we can compare that to the S&P 500 returns. And what you'll see here is that there's a spike in the VIX. You can see it start to shoot up here from a lower period. It's a minimum and then moves up. And as the VIX moves up, you can see that the market moves down. And that's people taking out hedges, taking out volatility spreads on the portfolio. So what you're trying to do is detect on a market-wide position when this starts to spike up so that you can then take out insurance on your portfolio. We have the market move down, you liquidate the hedge, and then get back into the market. And there's a saying in the market too, it says when the VIX is high, it's time to buy. You can see here are these peaks in the VIX, but it also corresponds to the low point, or the relative low point of the markets, like it down here. So when the VIX is high, you buy, that implies the low point, and then when the VIX is low, like down here, it's time to sell or stay away. When the VIX is high, it's time to buy. When the VIX is low, it's time to go. So you want to be careful down at these low volatility points. And we can see this is a 5-year plot that we're looking at. We can go back even farther than that to the late 80s. And the VIX is extremely low right now at 12. It has been around that low at other points in time, but not terribly much. So we're definitely in a low volatility period, low risk period of the market. My wife just got home. Anyway, so that's the first part. And this hedging strategy is trying to hedge out issues of systematic risk. And of course, your portfolio has in it not just systematic risk, but since you have individual stocks, there's idiosyncratic risk that's in your portfolio as well. Now, by diversifying the portfolio, we get rid of the idiosyncratic risk from a portfolio standpoint, but you still may have to hedge out an individual stock on its own. For example, right now, GM is experiencing problems because of recall in their vehicle, cars catching fire from bad ignition switches, lawsuits being filed, fines being levied, bad press coming out. That's all idiosyncratic just to GM. It's not cars in general or automotive in general. So these are times when you might want to take out an option directly on one of your underlying stocks. So the requirement for the project is to pick 5 of your stocks, I don't care which ones, and you need to do 2 call hedges and 3 put hedges. And I will say put hedges are more common than calls. And how do you do that? Well, the first thing you want to do is find out how many shares that you have. To do that, this is my Sharp Optimal Portfolio. I had $200,000 to invest. I spent 47% of it on, actually 47.38% of it, on 3M. I come over here, the closing price of 3M at the end of my portfolio formation was $87.35. So pretty simply all I'm going to do is, this is the monthly close, it's not a problem. All I'm going to do is take 47%, D4 times 200,000, and then divide it by the price that I got it at. So that gives me 1,085 shares. So that's what I need to hedge out. How do you calculate the hedge? The first thing you're going to do is get current price of the put and the call. And then you're going to come down here and run your what if analysis, your goal seek, to find the implied volatility. Once you have the implied volatility calculated for both the put and the call, your next step is to calculate the delta. This is the equation for the delta of a call, and this is the equation for the delta of the put. And I've added a link in here, but this particular website, Macro Option, gives you the equations. Here's my delta for the call and the put. My equation is a little different, but it's equivalent. This is the equation for gamma, which is the second derivative of the option price relative. It's how delta changes with the underlying change in the stock. Theta is how the price of the option changes with respect to time, more time, less time. This is what you use for your calendar spreads. We have Vega, which is how option prices change relative to volatility. We divide by 100 here, so we're looking at 1% increase in volatility and what the impact of that is. And Rho is how the option price changes based on interest rates. So you could also program those in, not a requirement of the project, but just to let you know where they're at. Alright, so I calculate my delta of the put and the call, and interpretation here says that if the stock price moves up by $1, the call will go up by 51 cents. Equivalently, if the stock price is moved down by $1, the call will drop by 50 cents. We're hedging out at $1 drop in the stock price. So how many options do we need to cover that? And the answer is pretty straightforward. We're just going to take the number of shares, that's G3, divided by 100. That's a quantity in negative sign. We don't have to negative that. And we divide by 100 because there's 100 shares per contract. And then we simply divide by the delta. And that tells us that what we want to do is have a negative 21 or negative 22 contracts. And negative means that you want to write them. So you want to open to sell to open the contracts, and then if the stock price goes down by $1, which means you'll lose $1,085, you'll gain exactly or roughly that in terms of the value of the drop in price of the calls. And then same thing for the puts. It's minus G3 divided by 100, and then we're going to divide it by the delta of the option. And what this says is we need 22 puts for a $1 hedge, between 22 and 23 puts to cover it. Okay? Now, just as a word of caution, in real world, the real difference between these two guys is when I write the calls, I start with money in my account. When I buy the puts, obviously I spend money at the beginning. And whatever money I spent here, if the stock price goes up, I can lose the entire value that I originally invested. So $1.97 per share times 2,200 shares. On the calls, the money comes into my account. Now, if the stock price moves up and the call's in the money, say I finish out at $145, for example, then the calls are going to get executed, and I have to invest. I have to sell as part of the call 2,100 shares. Well, I have 1,085 of them, but I actually have to go to the open market and buy the balance. So what I'm trying to say is that by writing the calls, you're actually taking on an infinite amount of risk, where by buying the puts, the maximum that you lose is the what you invested in them. And then again, a lot of times people will cover this call position by buying a call at a higher strike price, limiting their upside loss. On this side, they'll sell a put at a lower strike price to try and reduce the amount of insurance. And there's a little more rebalancing that you'll need to do in order to get the delta hedge exactly correct, but it's infinitely doable. And that's the basic project, again, written in paragraph form, and I'll have everything uploaded shortly. It's been a pleasure working with everybody. I know it's a lot of very difficult material that we went over. I really think everybody did well. So thank you very much, and have a great summer.